folks, Dan Frio here with your closing bell for September 11th, 2025. So even with a shocking number this morning, rates really didn't move. I expected rates, as you saw this morning with the MBSs, they spiked up right out of the gate and they just kind of petered out from there. So the question I'm getting now is, Dan, how far can these rates actually go? So we're going to kind of tackle that in today's show. I'm going to give you my forecast over the next 6 to 12 months. So you get a forecast reading today. I'll have a special event out probably in the next couple weeks, but I wanted to give you guys a sneak peek of what we're looking at today. The news that came out today, well, the equity markets loved it. The VIX is down. So far, we got a Cinderella story across the board here. The VIX is down, like I said. Let's see what cryptocurrency is doing. It is up 114. I'll take that. Oil is down. We completely have a Cinderella story, folks, for you today. So oil is down. That's helping on the inflation front. Okay, so here's the news we got for today. Consumer prices rose at a 2.9% rate. That was kind of what was expected. It wasn't a shock in the market. But the shock was how the jobless claims kind of jumped. And that was a little bit more surprising than expected. I know the jobs market right now is all over the map, but now we're starting to get maybe some true numbers on the jobs report. So we're going to take all this data here and try to figure out what the Federal Reserve is going to do in 5 days and what my expectations are for rates over the next, 6 to 12 months. So let's get over to our sneak peek for today. But first, folks, who am I and what do I do? Well, my name is Dan Frio. I do this report each day to help inform you guys why those are changing. Okay, so what we've seen is mortgage rates coming down. Can they keep coming down? How far can they go? But in turn, how quick can they go right back up? So one of the reasons I do these videos is right through here. And folks, I just want to provide you guys some information on, somebody asked me many times, why do you do this? Well, my whole goal is to educate you guys out there. I went to a small school in West Virginia. I'm no great there, but a lot of students coming out of school right now, if we look at the numbers, they're really not getting the education they need. So I want to come out there and at least help people understand the mortgage market, the real estate a little bit. And then we also do Stock Talk Tuesdays, where I kind of give beginners and moderate investors an idea on how stocks, bonds, and cryptocurrency works. But there was a report out today, and I was like, okay, is this accurate? Because if this is accurate, it's pretty dismal. So what I did is I did an AI and did some research, and here was the findings that I found out about the education in our students. How smart are they, and what are the grades right now? So a lot of people are like, we shouldn't have grades and things like that. But folks, we have to understand if our kids are getting it or not. So let's get over to this real quick. The reading, average scores fell 3 points. Compared to 1992, scores are down 10%. Here's the alarming thing. Only 35% of seniors are proficient in reading. Let's get over to math. Average math scores dropped 3 points. Only 33% of seniors are proficient in math. Nearly half of seniors are below basics in math. And then it goes through, and the only other data that it had for science and things like that was 8th grade. But this is pretty sad, where we have a third of our students not even able or not proficient in math or reading. So I hope I'm doing a service to you guys out there. And if you're a teacher or professor, have your class watch me, and hopefully they can learn some just basic economics when it comes to all this stuff. So without further ado, let's get over to my forecast, and I'm going to dive into the economic news that we have today and tomorrow. But I want to get to my forecast, and then we're going to take it over to Rick Santelli, which we usually do. He's with Steve Leisman on CNBC. He's going to tell you what the markets, what the data we got this morning. But I want to show you just, my thoughts of my forecast over the next 6 to 12 months. There is a range, and there is a couple scenarios that we could go through. So let's kind of dive into them. So here's what I did. I wanted to figure out where rates were going to go, and I needed help with AI with a lot of the logic. Okay, so let's get into it, because there's a lot of factors that play a role into this. So we're going to have scenario number one. We're going to say if the tariffs stay, what would happen? Because there's a huge difference between if the tariffs do go through, and I think they're going to go through at this point, or if they are deemed illegal, which then we're going to have to refund, I don't know how many, I think it was like $1 billion or billions of dollars in funds back to countries in regards to the tariffs. But let's get over to what we're thinking. Okay, so this is what I'm actually expecting at this time. The tariffs are going to stay. The 10-year Treasury, it's going to start to decline, especially with the Federal Reserve cuts. Okay, so my expectations, the 10-year Treasury is going to go down to about 3.5. Okay, right now we're at 4. We just teetered at 3.999, so we're at 4% right now. I'm going to say that's going to happen around Q1 of 2026, or we might even have it here sooner than I think. Okay, so that's one piece of that. So if that happens, what would happen to interest rates? Well, I'll squeeze in my forecast right now. I'm going to say it's going to be between 5.875 and 6.25. Okay, and this is going to be, again, Q4 of this year or Q1 of 2026. The logic behind this is the inflation data is going to start coming in kind of on point. The Fed's going to ease, tariffs are going to remain in place, and everything's kind of going to be okay. Okay, so that's, again, I'm always a half-glass full kind of guy. So let's say if the tariffs get struck down, and many people have said this could be Armageddon, and that's not my words, folks, that's theirs. So let's go and see what would happen. What would happen, we would have to refund all the money that we took in tariffs, okay? So we don't have money as a country already, so we'd have to issue more bonds. What's going to happen to bond rates? Well, this is what's going to happen. The 10-year Treasury, it's going to jump back up to 4.5, maybe to 5, because this might be a short-term trend where the bond vigilantes jump in once again, take advantage of the markets, and push yields up to 5. What could that do? Well, it'll push rates back up to right where we were when the bond rates were there and rates were 7.25. So that's what could happen if, again, the tariffs are struck down and kind of everything else kind of fits in place, but, inflation stays a little bit where it is in the jobs market as well. All right, so let's go back to scenario number 3, or on forward to scenario number 3. The Fed, inflation-driven easing. Let's say 10-year Treasury gradually slides to 3.7 to 3.9. This is my base case. Mortgage rates, they go to 5. This isn't my case. My apologies. It says my best case. This is actually the AI system's best case because this isn't mine. I'll show you what mine is. Mortgage rates range from 5.25 to 5.75 as spreads compress back to normal levels. If inflation drifts closer to 2.5 and the unemployment ticks higher, spreads might normalize. So this is what the AI system is saying. Okay, this is their best case. It asked me, do you want to comprise these and put this all together? And I said, basically no, because my best case and my thought process is 1 or 2. If the tariffs go through, you're going to see a pretty nice market. And you're going to see things starting to stabilize. I don't think you're going to see tariffs, making inflation crazy like a lot of analysts expected. And the reason why they do this, folks, is like the people that were saying that, housing prices are going to drop to 2008 levels. We've never seen it in history. Hopefully we'll never see it again. And this isn't an environment which would cause that. But so my thoughts are this, the tariffs will pass. The bond market's going to start to stabilize. You're going to start getting a lot of money from tariffs, and I'm going to go over that in a second because there's the Federal Reserve's forward balance is coming up here in a second. I'll show you that. But that's my scenarios. So I'm thinking if the tariffs go through, it's going to be kind of pretty nice. You're just going to see rates at 5.99 again. But if the rates don't pass or the tariffs don't pass, you're going to see rates 6.5, 7, maybe 7.25, and it could run fairly quick, basically as soon as the Federal Reserve comes out and tells us what they're going to do. Okay, so let's get over to the markets right now. The markets were flat, believe it or not. So the 10-year or the 30-year Treasury or 30-year fixed rate went down 0.02 today. The bond market right through here is MBSs are down or plus 8. Here's one of the things I wanted to show you. This right here, the federal budget. Let's zoom this in so you guys can see it. The federal budget. The last reading, it came in at negative 291,000. It was expected to come in at negative 285,000. It came in at a negative 345,000. That's a negative, folks. So this means we're collecting a lot of tariff money that's helping out the economy. But don't believe me. Let's go over to Rick Santelli and Steve Leisman. Let's let them give us all the details for today. It's a little lengthy, but it sure is worth it. Take it away, fellas.
Steve Leisman and Rick Santelli are here for what we should get on time, and that is the CPI. Rick, you got it? Or Steve?
Up 0.4% versus an estimate of 0.3%. Real earnings minus 0.1%. Obviously, the inflation number's taking that off. Let's see what we got here. Year over year, headline 2.9%, right in line. Food and energy 3.1%, right in line. No adjustment to the prior number. But the one thing is the headline, the core at 0.3 is exactly in line with estimates. Let's see what else we have here. Unadjusted. That's all I have right now. Joe, how's food was up 0.5%. So some pressure there. Food 0.4%. Owner's equivalent rent 0.4. A little bit of pressure right there. I don't have the actual table yet, but I'll get that in a second. Taking a look, we were if the bond market is reacting at all. That's what Rick would be telling us, but he's going to be here in a second. I still
God,
have
he
the
is.
2-year at 351. Rick, do you remember where it was going in? I can't remember. 10-year at 4.01. So that's actually down a bit on this number. Yeah, pretty big decline. I think market's seeing essentially, Joe, this inflation numbers in line with expectations.
Okay.
The key here, and I'll dig into the numbers, I expect to find tariff inflation in there. The key all along, the main risk to all of this was it going to spread to other things? That does not appear to be the case. That was the risk that held the Fed back. We can argue, did it make sense for the Fed to guard against that kind of risk?
Is this a big moment, Rick? Is that
263,000? Is that what I'm seeing on initial jobless
I
claims?
didn't see that, Rick.
Yeah, 263,000.
Okay, so do you understand why, like Rick, you have the other guy and, well, it's doing this and doing that, but Rick is back. So let's bring him back. So he's got a lot of data for us, folks. So welcome back, Rick.
That is the news of the morning. We haven't been above 250,000 since October of 24. So 260,000, where's that going to comp to? It equals where we were in June of 23. To find a higher number, you're back to October of 21. To me, that's the biggie. We're talking about, is the Fed fund futures market going to potentially price in 50? That is your catalyst to actually get there.
the price in 50? Where's the 10-year, Steve? I was thinking we might get a 3 handle.
10-year coming up. 4. That's what the market's reacting to.
Exactly,
Not
4.
the inflation number.
Exactly
4.
4.
We're waiting for that under
3
4
handle.
number. Your buddies in Chicago,
Yeah, listen.
who have the calls on that part, right?
On the 4th of, April, when we had our 3.99 yield close, the low close for the year for 10s. In Chicago, everybody was betting that we were going to spend a lot more time under 4%. I took the other side of that. I think debt and deficits matter. I think the yield curves matters. So I still say, even if we close, and it's based on a close, and a weekly close is your highest priority from a technical perspective. And once we get that, I think if I was a trader, I'd probably still end up fading it. I think if the Fed cuts 50, the yield curve steepens 25. I still think 10s are going to be there, and they're going to be stubborn. It makes me upset when I see everybody talking about 30-year bonds. 30-year bonds haven't been the biggie in over 20 years. And just because the UK and the Japanese, they trade those things by appointment, it gets distorted. Arbitrage keeps it in line. But you want to watch the 30s versus 10s spread, 5s versus 10s, the fight, the knob, because the steeper these get historically, the more that tells me that the premium in between these maturities is going to keep getting wider and wider.
Rick, I want to.
So that's where I want to stop it there because they keep going. So there is a risk premium, and let me bring up a newsletter that we're working on behind the scenes right through here. Where was it? I kind of wanted to give you guys my take on a lot of this stuff. Right through here. So a lot of the data that came in, it's not there. A lot of the data that came in that they were focusing in on came in right at point. I'll go to the economic calendar. So here's what I want you to focus in on for today is the CPI, all these CPI numbers. This is consumer inflation, folks. They basically came in all at point. The CPI month over month was a little bit elevated, didn't really move the markets at all. But like Rick said, this number right here, this number hasn't been above 250,000 since 2023. And they're starting to compile they're hoping that the jobs reports or the unemployed don't start to compile and start to accumulate here, meaning the jobs market is really tanking. The job market right now is such a who knows what the next report's going to be. But here's an interesting thing that came out today. 2 things. The Federal Reserve budget. Last reading was minus 291. Now it's minus 345. This is how much the tariffs are really helping, folks. But if you go right up through here, this is another great bead on the market. The last time that they had a 30-year auction to get rid of a lot of the debt, took a yield at 4.8 to get rid of it. Came at 4.6 now. So that's a 25 basis point move in there, a 15 basis point move in the market. So the markets, the rates are coming down. The jobs numbers are that's that wild card out there. But again, the one thing I need you guys to focus in on is right through here. Are the tariffs going to go through, or are the tariffs not going to go through? But Rick did say, some of the compressions and things like that with the risk, it is built into a lot of this logic. And I know it's in here, but look here, spreads normalize. You can see it through there. Falls deeper into the fives. And we did take that risk premium in here into effect into all of our budgets in there. So that's my forecast for, the rest of this year. I will have a special event where I do this and break it all down for you in more detail, but I wanted to share that with you guys today. But last but not least, let's get over to the economic calendar, or the economic report. When's the Federal Reserve actually going to cut rates? Well, let's go over to the Fed Watch tool that we have here. So let's bring it up. In 5 days, the Federal Reserve is going to be meeting. What are they going to do? Well, the odds now are huge. I think the odds earlier went almost up to 100%, but there's a 25% cut coming, is what the markets are saying. Then another 25% cut coming, and then another 25% rate cut coming. So that's what the markets are saying. This is all, again, in factor of the tariffs going through. We did create one last thing for you guys out there. We are working on calculators and tools to help you guys out if you're out there navigating home ownership. Okay, that's the biggest piece right now. People are trying to figure out how much can I afford with these rates and everything else. So we got a tool coming to you shortly, and I'm just going to preview it here in a second. What you're going to do is you're going to go through this and basically tell the system exactly your situation. And you're going to break it all the way down, and it's going to actually tell you every product that you're going to be eligible for. And you're going to screen through it and tell us exactly what you have, what your income is, and you'll even be able to figure out your income on here. Then when you're all done, it's going to break it down and tell you. And this is for people looking to buy homes. This is for realtors. This is even for loan officers that might not know all their products. Look at the programs available to you, from conventional, FHA, Home Possible, Home Ready, Jumbo, bank statements, asset depletion, FHA rehabs, reverses, and foreign nationals. You probably have all these in your arsenal. If you're a realtor, you have a loan officer that does this. If you don't, we'd love to help you. If you're a loan officer, you should have all these products. And if you're a consumer looking to buy a house, you probably don't even know half of these exist. That's why most people reach out to me and use my 35 years of experience in the business to work for you guys. So who am I and what do I do? Well, my name is Dan Frio. My goal here is each day to come out and explain to you what's going on in the markets and why these are changing each day. I've been a loan officer in the mortgage field for over 35 years. I'd love to work with you. If you're anywhere out there in the 50 states or Puerto Rico, I'm licensed in all those states because the bank I work at is licensed in all 50 states as well as Puerto Rico. The unique thing about this bank, though, is we have a slogan, and I created it. It's one application. It's one credit pool, and we're going to compare your loan to over 30 different lenders. Now, how do we do that? Well, actually, my bank, most of us that joined the bank used to be brokers, and we were broker owners, and we're like, hey, what if we could create this environment into having as many options for our customers as all brokers do? So that's what we did. We're set up with over 33 different lenders at this time. So if you're trying to reach out there and trying to find the best product to buy a house, try this one. Don't get one of those down payment assistance loans. If you do need one, don't get one that you have to pay back, because what's going to happen is when you go to refinance, you're going to have to pay it back. You might not have enough equity to do so. This one's forgiven. You don't have to pay it back, and it's not a lien. If you're looking to refinance, go into this refinance tab. It doesn't explain refinances to you. It tells you, basically, it's telling you to tell me what interest rate you want for me to call you back. We have over 250 of these that we've received over in the last month and a half from you guys out there. So please, when I reach out to you, you got to answer the phone, folks. I reached out to 10 people today. I'm waiting for responses. So if you want to find out, what rate you can qualify when it makes the most sense, well, put in the rate that you want to refinance at, or at least kick the tires on to see if, is it enough savings? We're going to go over how much the new payment would be, what the cost would be, what your break-even point would be, and you make a decision. If you want to refinance, great. We'll lock you in and get the paperwork started. If not, wait for rates to hopefully go a little bit lower based on those tariffs. So that's my report for today, folks. I hope you enjoyed it. Hope you learned something today. And if you're out there, please, stay tuned. Our mortgage calculators and other tools will be available to you soon. So thanks for watching. Have a great afternoon. God bless you. Be safe out there, folks. And I'll see you here tomorrow morning at the opening bell. Bye-bye.